please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to INDIANOMICS. The Indian economy is set for a slowdown in FY18. Welcome to this special edition of INDIANOMICS, where we are checking out the state of the economy after the release of the first advanced estimates of this year's GVA and GDP. The GVA, or the gross value add, is set to grow at just 6.1%, much below what the street was expecting and even below what the RBI had estimated the GVA to be. That estimate was 6.7%. This would be the slowest rate of growth of the GVA in the last 4 financial years. The last time we grew at 6.1% was in FY14. The GDP in the current year is set to grow at 6.5% according to the CSO, which is actually a distance more than the GVA. One was not preparing for such a wide gap between the GVA and the GDP. Even at 6.5%, this is the slowest rate of growth since FY14, which was nearly the last year of the UPA government. But the chief statistician, TCA Anand, said that these estimates may be on the conservative side. The budget, if you remember, had estimated the GDP at 168 lakh crore to arrive at the fiscal deficit estimate of 3.2%. But now with the CSO predicting the GDP to come down to 164 lakh crore against the 168 lakh crore, the fiscal deficit arithmetically could be 3.3% and not 3.2. So looks like a fiscal slippage is imminent simply for arithmetic reasons. But wait, there's one silver lining as well. When we looked at the data on per capita income, we now find that we are almost at 1,26,000, which is close to $2,000. So India is now in the $2,000 club when it comes to per capita income, although the pace of growth of even per capita income has slowed from last year. Well, those were the key highlights that we got from the numbers. There are some problems of extrapolation. Remember, this is the CSO, the chief, the Central Statistical Organization, extrapolating the full year number from the 7 months data. There are problems for that, and in a minute we will have the chief statistician explaining the problem. Thereafter we will have an elite panel of economists, Soumya, Kanti, Ghosh, the chief economic advisor at State Bank of India, Sajjid, Chinoy, chief Asia economist at JP Morgan, and Samiran, Chakraborty, chief economist at Citi. Gentlemen, welcome. Let me just start with what TCA Anand said in terms of whether this extrapolation could, by its very nature, be a little conservative.
Broadly speaking, implicitly there is an assumption in this whole exercise that was stated last year as well, because at this stage for both revenue collections and government expenditure, the only control variable which we have is budget, because these are policy choices of the government to some extent. We are implicitly therefore assuming in this exercise that budgetary targets will be met.
Okay, well, the chief statistician also went on to say that probably the extrapolation is on the conservative side. But nevertheless, 6.1 GVA this year, slowest in 4 years, and GDP 6.5%. Well, let me start with you, Samiran. Disappointed?
No, this is very much in line with our expectation. At least the GDP number we were forecasting 6.5, and this is pretty much in line with that. Yes, obviously, as you mentioned, the gap between the 6.5 and 6.1 of GVA is a bit more than what we were anticipating. So we'll have to see how much of that is getting created because the CSO is taking the budget numbers to be sacrosanct, and maybe the net indirect tax collection is arising out of the budget estimates rather than the trends that we have seen till now, and that might be one of the reasons why this gap is being created right now. But overall, not too surprised by the headline number. Yes, there are a few surprises in the details for sure.
Okay. Well, in that case, more likely the 6.5 will be revised lower if the tax collections fail, right? Rather than the 6.1 getting revised higher. Samiran?
Yeah, that risk is there, but at the same time, we have to see that the second half consumption expenditure growth has been taken to be lower than the first half consumption expenditure growth. And a similar thing is there for trade, hotels, transport and communication, where the second half growth rate is assumed to be lower than the first half growth rate. My fear is that since we do not have any seasonality pattern in GST collection, and both these components will have some amount of GST collection as an input into it, the extrapolation method for both these components might be more difficult than the other components where the seasonality patterns are more well established. Okay. So that could be the reason why we are seeing a slightly lower number which will get adjusted through the net indirect taxes. So overall, we are maintaining the 6.5% GDP growth, but the gap between 6.5 to 6.1 on GVA is something which we need to look out for.
Okay, what would your estimate be, Sajjid? Will the 6.1 be an underestimation? Because after all, we got a very strong PMI number of 54.1 in December. We got a very strong truck sales number. Some of the core sector numbers like cement were strong. So maybe we will do better than 6.1?
That's possible. Our own estimate is 6.7 for GDP. And I think there are two differences here between us and the CSO. The CSO at some level has to stick to the budget target. So it assumes that the fiscal deficit target of 3.2 is going to be met implicitly. And that means that fiscal policy will be more contractionary, where the assumption that the deficit will be closer to 3.5. So the fiscal impulse here is less contractionary, number one. Number two, what you pointed to is, if you look at averages over the last 7 months, you sometimes tend to miss the fact that in the last couple of months, activity has picked up in a slightly more non-linear manner, particularly exports. So if you extrapolate that forward and given our own global view on the first quarter of 2018, we're a little more hopeful on the export front. So if you add these two things together, that you're going to get some fiscal slippage, which is not good for macro stability, but good for growth, as well as the fact that net exports could be less of a drag in the next quarter, we end up with a number of about 6.7. But let me just step back and make a larger point. I think there are two ways to interpret this number. This was...
your GVA number would be?
This was... So I agree with Samiran. I think that the gap between GVA and GDP is very unlikely to be as large as this for two reasons. One is we haven't seen the kind of buoyancy in indirect tax collections that had been hoped. But more importantly, remember, oil prices are much higher. So subsidies will be higher in the second half. So it's a double whammy. Not only are net indirect tax collections lower, but subsidies could be higher. So we actually sense that the GVA number could be meaningfully higher, closer to 6.4 or 6.5. But the GDP, the gap between GVA and GDP could be lower, and therefore we have a GDP number closer to 6.7. But I think quibbling about 0.2 or 0.3 is not I think misses the forest for the trees. I think there are two ways to interpret these numbers. The glass being either half empty or half full. The half empty part is this was one of the years of the strongest global growth in the current expansion of 9 years. Global growth is at record levels. And unfortunately, even as every other emerging market accelerated, India has slowed meaningfully. Of particular disappointment has been net exports. If you look at the advanced estimates, exports for FY18 are the same as FY17, 4.5%. And imports are 11% in FY18 when the economy is slowing compared to 3% last year. But this is something we pointed out before, that net exports is the culprit this year, and people have different interpretations. We've got our own about supply chains impact. So that's the glass half empty. But the glass half full is whatever you assume for the second half of for the full year, the second half shows a meaningful acceleration, which is the good news here. Even under the CSO's assumption, even assuming that GVA number of 6.1, you're actually looking at second half GVA being 6.4 compared to 5.8 in the first half. So the good news is sometimes full year averages are misleading. This was a case of a tale of two halves. The first half was slow, the second half is picking up. Whether we end up at 6.5 or 6.7, I think is largely irrelevant in the grand scheme of things.
Well, it becomes relevant, Sajjid. I mean, we had 5.7 when it was a particularly disruptive month. I mean, a disruptive quarter. We were on the back of a demonetization, unusual disruption, and we were in the throes of a GST disruption. And therefore, 5.7, to say that we are better than 5.7 doesn't seem like a very happy thing to me. 6.1 looks meaningfully lower than the 6.7 that the Reserve Bank led us to believe. But let me get Soumya Ghosh's take on this. Soumya, you think we will do meaningfully better than 6.1, which the CSO has forecast?
No, I also believe so. The second half number should be better. I think let me just get some small of the statistical details out of the way. I think if you look at the chronology of the CSO estimates last year when I was following the number, last year they did the same time when it gave out the advanced estimates for last year. So on the last year of January, I think he's revised the number for the last year, and then after the budget on the 28th February, it revised the estimates for the same year. So this means that this number of 6.5% which has been released today has a very small shelf life around 2 months. So you will see actually these numbers getting revised on the 28th of February, just after the budget. And I was looking into the numbers. These numbers actually comes on an unchanged base of last year, which will get revised on the last week of January. So in my sense, there are a series of estimates which is coming up, and this 6.1% GVA is likely to be moved higher, purely on the basis of some statistical revisions last year. The second point which I like to mention, I think you were mentioning also at the beginning of the show, the GDP estimates for the budget was around 168 lakh crores. Yes. But this number actually has come down to 166 lakh crores. So basically on that basis and given such a huge number, I think the impact on the fiscal deficit should continue to remain limited. So it moves up around 3.29% or 3.3%. So slippage around 5 to 6 basis points. So my contention is that these numbers look a little bit on the conservative side, and possibly when these numbers come out, you will see a larger revision in the GVA estimates, but possibly the revision in the GDP estimates could be on the lower side. So you could actually land up having a GVA number for the full year maybe at 6.3, and a GDP number which may not be strikingly dissimilar from the 6.5% which you observe today.
Oh, right. So I think there is some consensus between all of you that 6.5 may mostly remain 6.5, but the 6.1 could get revised higher to 6.3. That's a little better, but not much better than the CSO's number. There are a lot of pitfalls when a statistical organization which is used to collecting numbers of a lagged period is asked to extrapolate. And we have none other than the former chief statistician, Dr. Pranab Sen, saying that this is one number he's not very happy with when the CSO puts out. Just listening to him, that questions the quality of the extrapolation as well. We will take a break and come back with more questions for our guests.
When I was the chief statistician and later as the chairman of the National Statistical Commission, we had objected to the CSO bringing out the advanced estimates, saying that it has the danger of coloring the actual figures when they do come out. We don't like the data generating agencies to make extrapolations. And the reason we did this is, all of these kinds of advanced estimates are based on a certain understanding of seasonality factors.
So the Central Statistical Organization has just announced that the GVA in the current year, gross value added in the current year, will be only 6.1 against estimates of 6.7%, which the Reserve Bank had given earlier, and the GDP will be 6.5%. We've been speaking with Soumya Ghosh of SBI, Sajjid Chinoy of JP Morgan, and Samiran Chakraborty of Citi as to how they see the economic growth panning here on. Well, Samiran, now that we have a 6.1 number from the most respected statistical organization in the country, how will this, gel with RBI? Already there is an upward bias to the inflation trajectory, and then growth is lower. So is this a long pause, or in spite of this, is RBI likely to hike? How do you see the central bank?
So our baseline view is that RBI goes for a long pause, tries to assess that how deep the slowdown is and vis-a-vis how sharp the inflation pickup could be and from where the inflation pickup is coming from. But at the same time, we have put out about a 30% probability of February rate hike also, partly because of the reason that although we are saying that the full year the number is lower, we are all projecting that second half is going to look reasonably better and FY19 is also going to be reasonably better. So if you look 12 months ahead, the growth outlook, at least the market expectation is that it's not going to be that bad. So if inflation remains the chief concern and RBI is comfortable that the worst part of growth is behind us, then there is a chance that they might just want to do a preemptive, precautionary rate hike just to ensure that the food price inflation or the fuel price inflation does not get too generalized for other items. But that's still not our baseline view. We only put a 30% probability to that view.
Very quickly, do you think that they might revise their GVA number in the coming policy?
It's possible, but my sense is that, as Shomo was mentioning, that there would be a couple of more revisions coming to this data very soon. They might want for those revisions to play out before changing their own numbers. They will not have incrementally much of information to change their own numbers other than what the CSO is saying.
Okay. Well, Soumya, what will happen to the Fisc now? Do you think, looking at the 6.1 number, the government might slash expenses in the last quarter to try and meet the fiscal deficit? Alternatively, would they not mind, swerving from the path of fiscal prudence and announce probably a 3.2, 3.3% fiscal deficit even for the next year, assuming this year comes at 3.5? How does this number change fiscal policy?
No, I agree with you, Latha, to your point that this year I think 3.2% is a goner. I think this year the deficit could touch 3.5%. But there are two interesting points attached to it. I think next year the budget is likely to be presented in July 2019. So therefore, if there is a possibility that this year the government envisages maybe a deficit which is lower than 3.5%, and next year in July 2019 when the new budget is presented, I think nobody will remember what was the deficit last time, and the markets will look at a new signal. Yeah. So from that point of view, I think what is more important is that keeping the fiscal deficit for this year within reasonable levels and not bother too much about the next year, because next year all of us know that we're going to start afresh with a fresh budget in July 2019 after elections.
So you won't mind bluffing now is what you're saying. Okay, Sajjid, we're running out of time, but very quickly, the impact on monetary policy and fiscal policy. Not much time.
So I don't see much impact on monetary policy. I think it's wrong to say India is slowing. I think the full year growth is slow, but the slowdown bottomed 2 quarters ago. All of us expect that growth's picking up, and most of us believe that next year growth accelerates further, if for no other reason than that global growth is strong and net export should be a bit of a help. Yeah. The key risk for me, the key headwind for the RBI is oil prices. Oil is now at close to $68 a barrel. This is a 35% increase in the last 3 months, but that complicates monetary policy because it in a way has stagflationary implications. It hurts growth, but pushes up inflation. Bottom line is, I think the RBI is on a prolonged pause because we do see core inflation has gone up, but still hasn't reached the levels close to 5% that would alarm the MPC. So
fiscal
I think
policy?
For monetary policy, it's a prolonged pause. I think in fiscal policy, I do believe that, Soumya, I think the chance of hitting 3.2 is very low at the moment. 3.5 looks more realistic. The only piece of advice I'll give the government is if you just look at the bond market, this is among the steepest yield curves in the last decade outside of crisis periods. So what the bond market is saying is the absorptive capacity of the market is very limited. So even if 3.5 were to be reached this year, looking forward, it's important that the government have a credible medium-term fiscal anchor that the bond markets can anchor towards, so that yields can actually come down. Otherwise, in a way, talking about the RBI at some level is irrelevant. The RBI can cut or raise rates at the short end, but the long end is being driven entirely by fiscal concerns at this point in time, and that's what drives benchmark borrowing costs for the corporate sector and the corporate bond market. So I think, therefore, having some fiscal anchor is important.
Okay. I'm really sorry, but just one number from all of you. GVA for FY19. Samiran?
We are looking at closer to a 7% mark for next year.
Okay, Sajjid?
We have a 0.4% acceleration, so under our assumption of 6.7 this year, it's 6.6 this year, it's closer to 7% next year.
Soumya?
We are just looking at around 6.9 to 7% GVA next year.
All right, gentlemen, thank you very much for joining me. I just want to end in an optimistic note. Even if this year GVA is between 6.1 or 6.3%, looks like 7% is not all that far behind next year. Thank you very much for watching this special edition of Indianomics.